Good morning, all you cyberpunks out there, and welcome to the BCB Cyber Series that takes on the tech stocks that can provide the cyber fuel we need to pursue our digital wealth passions. Today we're tackling those big dividend payers that can add passive cash flow to our portfolios. As we dig for the cyber fuel we need, we are always working to make sure the best of the best, those monster companies in tech, can perform a key portion and play a key role in our balanced portfolios. For dividend payers, BCB Cyber is always looking for forward annual dividend yields up over 3% as our key defining characteristic. Better yet, we're looking for great tech companies that we can build on over time, delivering consistent value and technological prowess. With some of the biggest names in information technology, international business machines, better known as IBM, leads the way for us today. Built on three key innovative platforms, artificial intelligence, cloud computing, and quantum computing, IBM is positioned like few others to help drive technology into its next society-altering breakthrough. Better still, we also get that great dividend. As we see here, the IBM dividend shows that they are currently paying a 5.25% dividend yield. That's $6.52 annually. With a key split recently announced, IBM is set to unlock value in an already undervalued company. With a current forward PE of 10.60, there is a lot of stored up potential value here for not only a great dividend, but also price appreciation. A cash dividend payer for 104 years now, IBM has a current track record of 25 plus years of consecutive dividend increases and is included with the best of the best dividend growth stocks. Before we dive too deep, though, we strongly advocate that we don't act solely on anyone else's opinion, not even ours. Make sure we are thinking for ourselves out there as self-definers and making our own decisions. In the end, the responsibility is on each one of us as individuals, so decide wisely. Jumping right in the BCB Cyberway, we cover three quick pieces of information so we can get moving on our day. First, we tackle the story to find out who and what the company is. Second, we look at the numbers, both positive and negative. And secondly, we discuss our position on the stock. This is TS2B, Tech Stocks to Buy, Dividend Payer Edition. This week we're taking on IBM again, that Armonk, New York tech powerhouse working to redefine artificial intelligence, hybrid clouds, blockchains, and so much more. Jumping right into the story, that story for IBM is one built on legacy, a commitment to the biggest fields of technological innovation, and surprising value. IBM began in 1911 and over the years has been transformed multiple times from punch cards to digital storage. IBM has long been a key player in the world of technological innovation, even when that meant changing the product line. That story today begins with yet another opportunity to redefine itself. IBM's merger with Red Hat just a year and a half ago, 2 years ago, that was a $34 billion merger that redefined IBM for a new age, has created a new industry behemoth in hybrid cloud technology. Forbes a couple years ago wrote an acquisition article talking about exactly this, digitizing IBM for the modern age. The addition adds to a company that already possesses incredible strength in cloud platforms. The company saw 19% growth in the sector along the last quarter, pushing a revenue of $24 billion. In addition, Red Hat demonstrated a 16% growth rate to fuel the fire even further. With margin expansion and cash generation a priority for this company, it has great legs to stand on for the future. Finally, due to the current climate regarding increased competition, the company has been responsive under the direction of new CEO Arvind Krishna, pushing to focus to AI and hybrid cloud in as unique and focused drivers of growth in the company, better positioning this company in particular for this trillion-dollar industry opportunity. Jumping to the numbers now, we flip the BCB Cyberway looking at 5 specific metrics. That's revenue growth, forward price to earnings ratio, return on assets, operating margin, and debt considerations. While IBM does have a key risk factor that we'll consider here in a moment, it also hits on several of the other key metrics we're talking about. It has a solid revenue stream, a promising value proposition, a well-covered dividend, a positive return on assets, a positive operating margin, and a solid growing cash flow alongside investment, like that one in Red Hat, that will help with those debt considerations. We see here a solid revenue profile, keeping those sales numbers above $70 billion the last several years. An incredible sales opportunity there. A value proposition in current forward PE of 10.60, like we mentioned earlier, representing a discount to the market, and even more, a significant number. The price to sales ratio in the most recent quarter of 1.48 represents a deep value to the revenue stream. Strong operating margins, as we see here, is one of the better ones that we've actually seen. Also, we see a high-quality return on assets at 3.69%. This is all indicating strong and effective management. A balance sheet that suffers under the weight of acquisitions does exist, but it is not out of proportion to the company or the quality of the Red Hat acquisition. That was a $34 billion acquisition, as you see here, and accounts easily for half of that debt that they carry in the most recent quarter. We also see a strong commitment to that cash flow, as talked about. $15.79 billion operating cash flow in the trailing 12 months. Analysts have also demonstrated an undervalued nature, with averages and high-end price targets being significantly above the current share price as we see here. The average price target is $137.13. Currently, we're trading at $124.35. Finally, as this dividend payer, BCB Cyber loves to see that 3% forward annual dividend yield. And again, we've got that here with 5.25%. But more importantly, during very tough times around the globe, the company has a healthy payout ratio of 73.61%. Looking deeper into the numbers here with the dividends now, we do see that 5.25% is a growth actually for the dividend ratio. Like we talked about earlier, they've got 25 years of growth. Flipping out of the BCB Cyber Take, we do see here with the snowflake analysis that even though they believe that there's an adequate future and adequate health and an adequate past, there's an incredible dividend opportunity here from Simply Wall Street. We go a little bit further. BCB Cyber believes that analysts are simply losing out on this incredible opportunity, not putting more into it. They see a great dividend, which we agree with, and a fair value, which we also agree with, but they don't see the value in the Red Hat acquisition like we do. As of this morning on 11/28/20, that's November 28th, 2020, my own portfolio has a position of 9.07% with an average cost ratio of $114.46 in IBM. This is definitely a dividend payer worth buying at the right price, and one that BCB Cyber believes to be the right fuel for the fire. In addition, the Red Hat opportunity is an incredible one in terms of pushing forward the future opportunities in the hybrid cloud, so make sure to check out IBM. As always, we think for yourself, do your own homework, and make sure we're all cyberizing our own lives with the best in disruptive tech. Learn more in our wealth section, dive deeper with our establishing the baseline section. All can be found at our blog at bcbcyber.com. Make sure you guys have a great week out there, and we'll talk to you soon.